Make sure to get your free money from Moomoo. Use my link down below. Deposit at least $100, and you could get up to 5 stocks, each of which could be valued up to $3,500. And on top of that, you get a free share of NEO guaranteed. So again, use that link, deposit at least $100, and you get that free money. And with that being said, let's break down some stocks that I believe are a bit overvalued, even though the markets have been getting hit a lot recently. If you guys take a look here, SPY is down about 12% from all-time highs. It is officially in correction territory, and you guys know Triple Q got into bear market territory recently and is currently down about 21% from all-time highs. So I want to break down again a couple of stocks here that I believe are still a little bit overvalued, even though the markets have been down a lot. And I'm not saying these stocks are ridiculously overvalued to the point where they're just insanely overpriced, but they are a little tad bit overvalued in my opinion, and we'll break down why I believe that. So if you all find value, hit the like button, subscribe, and let's jump into the video, starting off with what the markets are doing right now. It's currently about 11:20 a.m. on the East Coast. We have SPY up 0.6%, the Dow's up 1.1%, the Russell's down about 0.5%, and we have the NASDAQ down 0.1%, pretty much sitting at break even, as the VIX is down 0.9%, and we have the metals taking a hit. Gold's down 1.2%, silver's down about 2.7%. So it seems like here on the 20-day chart for Triple Q, we are breaking the wedge, the bottom of the wedge, which is not a good sign, and it looks like we're going down to test 320, which was that level of support earlier here in March, about a week ago. And if we break under today's intraday high, intraday low, which is right around, let's see here, 322. If we take out 322, we're probably going to 320, and if 320 breaks, we might be at 317 before we know it. And now Triple Q went down from 0.1%, negative 0.1% when I started the video. Now we're down about 0.25%. And when it comes to SPY, let me pull this chart up. You guys can see it's doing the same thing. It's slowly starting to take out the lows from last week. The lows from last week, well, one of them being around 421. We hit that point earlier today. You guys can see we hit 419. So we took the lows out this morning. Now all we have to do for more bears to come in on this, to push it lower, SPY, if it breaks under, let's say 415 and 420 initially and then 415, it's going to collapse down to 410 most likely, 415 being support from earlier in March. So that's kind of a quick rundown on what's going on in these markets right now. Nothing crazy. We're getting a little bit of a pump, but as always, with all of these pumps that we've seen the past couple of weeks, they've mostly been sold. So I'm not really trusting this rally, let's put it that way. And it could really just be a sell the rip opportunity, like what we saw on Friday when we saw a big pop in the morning, that rip got sold. It might happen again. So we got to be careful. And of course, I'd love to know your thoughts. Drop me a comment, hit the like button, and let's talk about some of these stocks that I believe are still overvalued, some more than others. And number one, which might be a bit controversial, and let me say this right off the bat, I own this stock and I've owned it for a while. It's Apple, ticker symbol AAPL. Apple right now is sitting at a $2.5 trillion market cap. PE right now, trailing 12 months, is 25.72. So like I mentioned in the beginning of this video, these stocks aren't ridiculously overvalued, but they're not cheap either. They're not undervalued. They're probably a little bit over, I don't want to say fair value, but maybe they're just a little bit overvalued. And that's kind of where Apple is right now, in my opinion. 25.7, trailing 12-month PE. The dividend is 0.5% for crying out loud. I think their dividend did get up to 1% at one point. I might be mistaken on that, but dividend super low. They pay about 88 cents per share. And again, I'm not bashing on Apple by any stretch of the imagination. I own it, and I have owned it for a while, but I did trim a little bit recently. I guess I trimmed at a timely, a good point, let's put it that way, because we got news this morning. Let me just switch gears here for a second. We got news that Apple supplier Foxconn halts production as Shenzhen locks down amid a COVID outbreak. So we are seeing a bit of a COVID outbreak over there in China. And Foxconn, if you guys didn't know, it's one of the largest, it actually might be the largest producer of the iPhone. You know, they assemble, they produce the iPhones. So although this probably won't be a long-term problem, it's going to be a short-term thing. It's worth watching, as we are seeing Apple going down. It's currently down about 1% on the day. It was down even more earlier. It's sitting at 153 now. We got down to 151. So it was down at one point 2.5%. So we have recovered some of the losses intraday. But overall, look, this stock is only down 15% from all-time highs. Triple Q is down 21%. We have a lot of other tech stocks getting destroyed. So this one's holding up well. It's fantastic. And I'm not telling you guys to punish your winners by just selling out because it might be a little bit frothy. Because at the end of the day, Apple is a great company. It's worth owning. But I'm just saying, if you think it's undervalued here, I don't really think it is. I think if the markets do get another leg down, maybe if Russia-Ukraine gets worse, maybe the Fed surprises us, stocks get hit even harder, I think this could come down a good chunk more. And if it gets to a PE, again, it's currently about a 25.7. If it gets down to a 20 PE, an 18 PE, that's where I will be buying way more Apple. And like I said, I actually trimmed some Apple last week at $162. Now we're at $153. I trimmed some of that just to raise some cash because I was a bit overweight, and I still thought Apple was at a price where I'd be willing to sell some. So I did that, raised some cash, and now we're down a little bit more from where I did that. And I'm going to be watching it. If it gets down to, let's say, 130, 125, that's where I might consider buying back more Apple. So watch out for it, guys. I'm not bashing it. I love Apple, but I'm just saying it's not the most undervalued. It's not the best deal out there. I'd rather buy Google much more than Apple if we're talking big tech valuation right now. Starbucks is another one which is currently down about 37%. And the truth is, this one might still be a little bit overvalued. It's not a screaming price quite yet based off what I'm seeing here, you know, and these metrics, right? 92.79 billion market cap right now. The PE's at 22 still. If this gets into the teens, guys, it's almost there. It's almost there. If this gets into the teens, we're talking a 17 PE, an 18 PE, that's when I'm going to be willing to buy back my shares, because this is one that I used to own. You guys in my Patreon know, if you want to join that, link down below. You get all my buy, sells, call outs, morning videos, Discord access, more access to me, all that good stuff. I used to own this in the 70s before it ran up to 126. So I owned it 70, 75, 80. I bought some shares. It ran up. I offloaded the position, and I told myself if Starbucks gets back under 90, gets back under 80, I'm going to start buying. And now we're at $80. Stock's currently down 3%. So I'm looking to buy back the shares again if the PE comes down a little bit more, because we're not at a fair value yet, in my opinion. We're not undervalued, but if it comes down, let's say another $10 a share to $70 and under 70, now we're going to be talking about a very good deal when it comes to Starbucks stock. And they currently pay a 2.3% dividend, almost $2 a year per share. It's getting there. You know, if that dividend gets to a 2.5%, 3%, that's going to be a very good price for Starbucks, in my opinion. Amazon is another one which is currently down 1% on the day, losing a bit of value today. Nothing crazy, down $35. And I think this one's still a little bit frothy. The PE right now is a 45, and mind you, they grow a lot. And companies that grow a ton, they do require you to pay more for the shares, hence paying more in terms of a higher multiple. So 45, it's debatable. Is that too much, too little? What is it? What's the future growth? That's all debatable. But from my perspective, 45 is a little bit too frothy, because what we want to do is we don't want to buy stocks at fair value or a little bit overvalued. We want to buy them when they're going down drastically and they're at fair value or undervalued, right? So Amazon, sure, you can buy it now at maybe a little overvalued, near fair value. It depends on how you value it, right? You could buy it now and get a pretty decent return long term. But if it comes down to, let's say, 2,200, 2,500, and it gets more into that undervalued territory, fair valued, undervalued, that is where you could pick it up and get bigger returns, but you got to take more risk. That's the whole thing, guys, because this is an individual stock. Individual stocks are more risky because it's one business. It's not an ETF or an index. That's a bunch of businesses. So you always take on more risk. I mean, it depends the way you look at it, but generally speaking, you take on more risk when you buy one stock. So keep that in mind. But again, there's bigger returns if you are right. And they just announced a 20-for-1 stock split, which is worth mentioning, which a lot of people could argue or will argue that people are going to be buying up this stock before the split. The split, it going down, 20 times here, and it's a 20-for-1 split, by the way. It's going to go through early June, I think June 3rd. People are going to be buying the stock because it's cheaper in dollar value, so that might shoot the stock up. So there's going to be a lot of speculation around Amazon and Google for that matter, because both of them are doing a 20-for-1 split, which is great because I love Google. That's one that I'm in that I think is in fair value territory right now, and if it gets under 2,200, we might as well pull it up. Google's P right now is a 22 or something like that, and for the growth Google has, it's ridiculous, and it's currently down 1% on the day. If it comes down under 2,500, under 2,450, 2,400, that's where it's going to slowly, based on my projections, valuation, and my opinion, that's where I think it's going to go to undervalued, 2,000, and especially under 2,000. That is a ridiculous deal for Google. And the last one here, which admittedly I have to do more homework on, but I know a little bit about Nvidia. I think Nvidia, even though it's run up a lot, and I've mentioned this even before it ran up, guys, if you've been watching my videos for a while, I've mentioned how Nvidia, I think, is overvalued even before it ran up to 350. I mean, I was saying this when it was at 200, again, a couple of months ago. So right now they have a P ratio of a 56, which is very high because they grow a lot, but that's debatable if it's if the multiple warrants the growth. I don't know. Their P right now, or rather their market cap's a 540 billion market cap, and they pay a 16-cent dividend, which is 0.07%. So practically nothing is being paid out in dividends. So this is one that I believe is a bit frothy, even though it's down 35% over the past couple of months. It's well in a bear market here. And if we just take a look at the technicals, guys, let's look at this chart. What we're noticing is a descending triangle. We've been making lower highs for months, ever since we hit that all-time high back in November, and we've been holding around 210, 215 as support since the beginning of 2022. So if we take out 210 and break under 200, guys, this descending triangle is going to play out. We're going to get that massive leg down. I mean, it's not guaranteed. Nothing's guaranteed. But if this pattern plays out, markets get uglier in general. Nvidia is probably going to go under 200. And at that point, we're going to start getting to decent levels, in my opinion, because again, before that run-up, we were at 200. I want to get Nvidia under where it was before that run-up, and honestly, before it was during the split. We saw a stock split this past summer. It's close to a year ago at this point. We got that stock split. I would like to get Nvidia anywhere from $150, $140, $175. Call me crazy, but that's my price target, and I'm sticking to it. And if it doesn't get there, oh well, I won't own Nvidia. That simple, guys. So overall, guys, that's it for the video. Hope I did bring some value to you all and, made you look at things from a bit of a different perspective. I'm not bagging on these stocks. I don't hate these stocks. I like all of them. They just have to come to a better price for me to buy more or for me to initiate a position in the ones that I don't own yet. So if you all found value, hit the like button, subscribe, drop me a comment, and make sure to get your free money from Moomoo. Again, use that link down below, deposit at least $100, and you get up to 5 stocks, each of which could be valued up to $3,500. And on top of that, yes, there's more. You get a free share of NEO, guaranteed, guys. Again, use that link down below, and feel free to join my Patreon if you want all my real-time buys, sales, call-outs, morning videos, all that good stuff is on Patreon, link down below, or you guys can go to stocksurfest.com/Patreon. I'll catch you all in the next video. Thanks for watching. As always, peace out.